The US housing market is shifting again. And if you're thinking about buying a home, selling one, or investing in real estate, this could be the most important year you've faced in a long time. Just a few years ago, homes were selling in days. Buyers were waiving inspections, and prices were skyrocketing across the country. Then mortgage rates surged, affordability dropped, and suddenly the market felt frozen. Now in 2026, people are asking one big question: are we heading toward a crash, a rebound, or something completely different? If you've been waiting for prices to fall, wondering whether rates will finally drop, or trying to figure out if renting makes more sense than buying, you're not alone. Millions of Americans are stuck in decision mode, unsure whether to move forward or sit on the sidelines. And here's the truth: the housing market today is not the same as 2020, and it's definitely not 2008. The forces driving prices right now are very different, and understanding them could save you tens of thousands of dollars. In this video, we're going to break down exactly what's happening in the US housing market, including where home prices are heading, what's going on with mortgage rates, why inventory is still tight in many areas, and which states are actually seeing opportunities. We'll also talk about affordability, the rent versus buy debate, investor activity, and the key risks that could shape the market over the next 12 months. By the end of this video, you'll have a clear picture of whether this is a smart time to buy, sell, invest, or simply wait. So, before you make any major real estate decision in 2026, stay with me, because the data and trends we're about to cover might completely change how you see the market. Home prices are the first thing everyone looks at when judging the health of the housing market. And in 2026, the story is more nuanced than headlines suggest. Nationally, home prices are no longer skyrocketing like they did during the 2020 to 2022 boom, but they also haven't collapsed. Instead, what we're seeing is stabilization in many regions, mild growth in others, and selective corrections in overheated markets. During the pandemic-era surge, ultra-low mortgage rates and remote work flexibility pushed demand to historic levels. Now, with higher borrowing costs, buyers are more cautious. However, the reason prices haven't crashed is simple: supply remains limited. Many homeowners locked in mortgage rates below 3% and are reluctant to sell. That lack of inventory continues to support pricing. In some Sunbelt cities, prices are still rising due to migration and job growth, while certain tech-heavy metros that experienced rapid appreciation are seeing modest pullback. It's important to understand that real estate is hyperlocal. National averages can hide dramatic regional differences. Another factor to consider is inflation-adjusted pricing. While nominal prices may appear stable, real prices adjusted for inflation have softened slightly in several markets. This suggests cooling rather than collapse. For buyers, this means fewer bidding wars and more negotiation power than in previous years. For sellers, it means pricing correctly is critical. Overpricing in today's environment can lead to longer days on market and eventual price cuts. Overall, home prices in 2026 reflect a market that is rebalancing, not imploding. Mortgage rates remain the single biggest driver of housing affordability in 2026. After aggressive rate hikes in previous years, borrowing costs climbed significantly from historic lows. The average 30-year fixed mortgage rate is still far above pandemic levels, and that has dramatically changed monthly payment calculations. A 1% increase in mortgage rates can add hundreds of dollars to a monthly payment on a typical home. That shift alone has priced many buyers out of the market or reduced their purchasing power. Instead of stretching for their dream home, buyers are downsizing expectations or delaying purchases altogether. However, there is growing speculation that interest rates could gradually ease if inflation remains under control. Even a modest rate decline could unlock significant demand. This creates a tricky dynamic. Some buyers are waiting for rates to drop, but if rates fall, demand may surge again, pushing prices upward. It becomes a trade-off between price and rate timing. Affordability indexes show that in many parts of the country, housing affordability is still strained compared to historical norms. Wage growth has helped somewhat, but not enough to fully offset higher borrowing costs. First-time buyers feel this pressure the most. Creative financing options, adjustable rate mortgages, and rate buy-down strategies are becoming more common as buyers look for ways to manage payments. Ultimately, understanding how rates impact total long-term cost, not just the home price, is critical for making a smart decision. One of the most important reasons the housing market hasn't seen a dramatic price drop is the ongoing inventory shortage. In simple terms, there are not enough homes for sale relative to demand. A major factor behind this is what many analysts call the locked-in rate effect. Millions of homeowners secured ultra-low mortgage rates during 2020 and 2021. Selling their home today would mean giving up a 3% loan for a 6 or 7% loan. For many, that financial jump simply doesn't make sense. As a result, fewer existing homes are hitting the market. At the same time, home builders are trying to fill the gap. New construction activity has picked up in certain regions, especially in growing states with available land. However, construction costs, labor shortages, and zoning regulations limit how quickly supply can increase. In some markets, builders are offering incentives like rate buydowns or closing cost assistance to attract buyers. While inventory has improved slightly compared to the extreme shortages of 2021, it remains below long-term averages in many areas. Low supply acts as a floor under home prices, preventing steep declines. For buyers, limited options mean competition still exists for well-priced properties. For sellers, low inventory can be an advantage, but only if pricing aligns with current affordability conditions. The supply imbalance continues to shape the market's overall stability. The US housing market is not one single market, it's a collection of thousands of local markets behaving differently. In 2026, regional variation is more pronounced than ever. States in the Sun Belt continue attracting migration due to lower taxes, job growth, and relatively affordable housing compared to coastal metros. Cities in Texas, Florida, and parts of the Southeast remain active, though growth has moderated. Meanwhile, some previously booming tech-centric cities experienced slower demand after remote work patterns shifted and affordability peaked. Urban cores that saw temporary declines during the pandemic have rebounded in certain cases as workers return to offices. Suburban and exurban markets, which benefited from remote work flexibility, are now stabilizing. Climate considerations, insurance costs, and local economic strength are also influencing buyer decisions more than before. For example, areas with rising insurance premiums due to weather risks are seeing affordability pressure beyond just mortgage rates. Job growth remains a critical factor. Markets with strong employment bases tend to sustain housing demand even in higher rate environments. Investors must pay attention to these regional dynamics because what works in one state may not work in another. Understanding migration trends, local wage growth, and supply levels is key to identifying opportunity. The rent versus buy debate has intensified in 2026 because higher mortgage rates change the financial equation. In some cities, renting a comparable property is currently cheaper on a monthly basis than buying, especially when factoring in property taxes, insurance, and maintenance. However, buying builds equity over time, while renting does not. The right decision depends heavily on personal financial stability, time horizon, and local market conditions. A key concept to understand is the break-even point. How long you must stay in a home for buying to make financial sense compared to renting. In high-cost markets, that timeline may be longer than in more affordable areas. Renting offers flexibility and lower upfront costs, while buying offers long-term wealth-building potential and stability. For individuals planning to relocate within a few years, renting may be safer. For those planning to stay put for 5 years or more, buying may still provide advantages despite higher rates. Another consideration is rent inflation. In many areas, rent prices rose sharply over the past few years, though growth has slowed recently. Buyers must evaluate not just today's numbers, but future projections. Ultimately, the rent versus buy decision should align with both financial math and lifestyle goals. Real estate investment trends in 2026 reflect a shift toward caution and strategic analysis. During the low-rate era, investors focused heavily on appreciation and rapid equity gains. Today, with higher financing costs, cash flow has become more important. Investors are running tighter numbers and prioritizing properties that generate consistent rental income. Long-term rentals remain popular, especially in markets with strong job growth and population inflows. Short-term rentals face increasing regulation in many cities, making due diligence critical before entering that segment. Institutional investors remain active, though not at the same aggressive pace seen in previous years. Another trend is value-add. Investing purchasing properties below market value and improving them to increase rent potential. Rising property taxes and insurance costs have also impacted investor margins. Those entering the market now must focus on fundamentals, location, rental demand, and conservative financing. Real estate can still serve as a hedge against inflation over the long term, but quick profits are less common in today's environment. Investors who approach the market with patience and discipline are more likely to succeed. Foreclosure activity is another important indicator to watch in 2026. While there has been a slight uptick compared to pandemic-era lows, foreclosure rates remain below historical crisis levels. Strong labor markets and homeowner equity cushions have prevented widespread distress. Unlike the 2008 housing crisis, lending standards in recent years have been stricter. Most homeowners hold fixed-rate mortgages and significant equity due to prior price appreciation. However, economic uncertainty could change conditions. A recession, job losses, or prolonged high interest rates could increase financial strain on some households. Monitoring employment data and consumer debt levels provides clues about potential stress points. If foreclosure inventory were to rise significantly, that could increase housing supply and put downward pressure on prices. At present, the data suggests resilience rather than systemic risk. This reinforces the idea that today's market dynamics differ fundamentally from previous crashes. Demographics are playing a powerful role in shaping housing demand. Millennials, the largest generational cohort, are in their prime home buying years. At the same time, older homeowners are aging in place longer, reducing turnover. Generation Z is gradually entering the market as well, though affordability challenges remain significant for younger buyers. Population growth in certain states continues fueling demand, especially in regions offering employment opportunities and lower living costs. Household formation trends also matter. As more individuals form households later in life due to economic pressures, demand patterns shift. The long-term outlook for housing demand remains supported by demographic momentum, even if short-term affordability slows activity. Understanding these generational forces helps explain why demand has not collapsed despite higher rates. Looking ahead, 2026 presents both risks and opportunities. If inflation continues to ease, interest rates may gradually decline, improving affordability. However, rate cuts could also reignite competition and push prices upward again. A mild economic slowdown could cool demand further, while a stronger than expected labor market could sustain price stability. The most likely scenario appears to be gradual normalization rather than dramatic swings. Buyers and investors who focus on long-term fundamentals instead of short-term headlines are better positioned to make sound decisions. Timing the market perfectly is nearly impossible. Instead, evaluating affordability, financial readiness, and local conditions will be the key to navigating the evolving U.S. housing landscape. The U.S. housing market in 2026 is not crashing, and it's not exploding either. It's recalibrating. The frenzy is gone, but opportunity hasn't disappeared. What we're seeing right now is a market driven by fundamentals, affordability, inventory, local job growth, and interest rates. And that means the winners in this cycle won't be the people trying to perfectly time the market. They'll be the ones who understand it. If you're a buyer, this is no longer a panic-driven environment. You have more negotiating power, more time to analyze deals, and more room to make smart financial decisions. If you're a seller, pricing correctly and understanding your local demand is more important than ever. And if you're an investor, this is the season for discipline, strong cash flow, conservative numbers, and long-term thinking. Remember, real estate is not about headlines, it's about math, patience, and strategy. Markets move in cycles. Those who educate themselves during uncertain times often build the most wealth over the next decade. So instead of asking, is this the perfect time? Start asking, am I financially prepared? And does this deal make sense for me? That shift alone can change your entire outcome. If you found this breakdown helpful, comment below and tell me, are you buying, selling, investing, or waiting in 2026? And if you want weekly updates on US finance, real estate trends, and smart money strategies, make sure you subscribe and turn on notifications. The market is evolving fast, and staying informed could be the difference between a costly mistake and a life-changing opportunity.